Hi, it's Kris Benson. I'm the Chief Investment Officer at Reliant Real Estate Management. I appreciate you taking the time to watch this video today. Today we're going to answer a question we get a lot here is, how do I invest in real estate? And today we're going to go over really, I think, the major decision you have to make as an investor. And once you make that decision, you can go down two different paths. And the decision you first need to make is between, do I want to be a direct investor or a passive investor? And for those of you guys who don't know what that means, direct investor essentially means you're out buying your own property. So, maybe you're going to buy a duplex or a self-storage facility. You can buy your own office complex, and essentially, once you buy that facility, you're in charge, right? So you may hire a third-party management firm to run it, or you may do it yourself. There's a lot of people who get started managing their own properties. And the other side of that is the passive world, where you're deploying capital with either a partner or a professional real estate organization like Reliant in an effort where you get access to the asset class and the exposure of your investment in that asset class, but you're not doing any of the work. The real key between the two is where you want to spend your time, right? I'm a believer in, kind of the Malcolm Gladwell 10,000 hour rule, and it takes 10,000 hours to create mastery. And so, if you're a direct investor and you're new to real estate investing, you're going to spend some significant time working out the kinks. And some people really like that. The upside to spending that time is you're going to make more money, right? If you invest passively or with a partner, you're sharing that. And so, I think the big thing most of our investors is they make a decision of, okay, look, I don't have the time to spend on real estate investing direct. So I'd like to be in a passive role and partner with somebody who can do this for me. And I think there's a few ways you can do that. So as a passive investor, you can work with a syndication. And all a syndication is essentially an airplane flight is a syndication. It's the total cost of something is too great for one person to do, so they divide that up into a bunch of people, and it makes it palatable for everyone. So, I can't charter a jet from New York to LA, but if I have 300 of my closest friends on there, we can all split up that cost and we can make that flight. Same thing holds true with real estate. One investor may only have $100,000 to invest and the property's $1 million equity requirement. And so the syndication allows 10 people to put in $100,000 and they can make up that $1 million equity requirement. And so those syndications are available a couple of different ways. They call them country club deals, where people used to have to essentially have access to a friend or a buddy or somebody in the industry who knew people were offering these. With the advent of the Jobs Act a few years ago, crowdfunding platforms for real estate syndications have become very relevant in the market. And so there are things that you may have seen online. CrowdStreet is one, Realty Mogul, Fundrise. There's a number of them where they work with companies like Reliant to find deals, and we put our deals out on those platforms, and then investors can access those investments through their web-based platforms. And it's been a huge shift in how money has been raised for a lot of investors, because it just instantly gives the operator access to a lot of web-based investors, and it gives investors access to a lot of different real estate operators. You can see lots of different types of operators: self-storage, multifamily, office, medical buildings, senior housing, et cetera, et cetera. It gives you all that in one place. So crowdfunding's been a great shift in how people have invested in these syndication platforms. Another way you can be a passive real estate investor is through REITs, real estate investment trusts. So there are non-traded and publicly traded REITs. The publicly traded REITs are the one most people know about. They are essentially a stock or a mutual fund, but instead of buying shares of individual companies, they're buying shares of real estate properties. So you as the investor get exposure to all of these different real estate properties that the REIT isn't investing in. The upside to REITs typically is they're liquid. You can trade in and out of them, where real estate typically is an illiquid asset. The REITs solve for that problem. The downside to REITs is typically the returns are not outsized. You can, if you're willing to hold on to your money a little longer, usually there's a little more upside for the investor. So these are all things that you can consider as you think about investing in real estate. I think, again, the first decision you need to make is, do I want to be a direct investor or a passive investor? And then from there, you can certainly find opportunities in each facet that will allow you to do what you'd like to do. So I appreciate you watching this video. If you want to learn more about Reliant Real Estate or any of our investment opportunities, you can check out the website. We'll have the link listed on the bottom of this video. It's www.reliantinvestments.com. Thanks so much. Have a great day.